All right, so I think this is what you should have got for this one. Okay, so tonight what we're gonna do, sorry about, I don't know, 15 minutes in. I've been in meetings all day. My head's like in a bubble. Yeah, we can go ahead and do this one, I guess. Did you guys already do this one? Do you know number five already or no?
I worked on it.
Okay, well, we'll go through it. We'll go through it. Okay. Copy this over. Yeah, so the assets at fair value, and then we're gonna subtract out. That's all the same. Okay, so total assets at fair value. Minus the liability. So this is identifiable assets. Cash price paid was 67.50. So if there's only 6,000 of identifiable assets, then the goodwill would be 750. We're gonna have a bad will problem today. That'll be fun. They don't call it that anymore though. Okay, so let's go ahead and start putting the stuff in. Rid of the stock. And again, the weird one here compared to what we did before is we always have to go back to the beginning uh, for the retained earnings. Oh, wait, I forgot to put in the all important, this stuff. It is freezing in this classroom. Okay, so we're going to take the stock out. Okay, so we get rid of the stock. And now we go to the assets. And the assets are 300 and 600 and 750 for the goodwill. It's a shame these two are the same amount. It's an unhappy coincidence between the accounts payable and the goodwill. It's just, they're generally not related. Okay, so 300, 600, and 750. I wish I could tell you, I don't have the screen on it here. I can't get it to turn on, so I can't tell what color this is actually showing up as. But anyway, these will be the assets. And again, we're really just taking this off of in the investment account. We got to get this investment account to disappear. Because we're going to already have that stuff in our, for all these to get added in. Okay, CD, dividends, the easy one. Oops. Said it was easy too quick. Okay. Okay. Hopefully you guys can see those. Okay, all right, we gotta get rid of the income. And, oop, no, no, don't do that. Green. And then the last one, which is the expense one that does not hit the uh, investment. Oops. So excess building, land isn't gonna get depreciated, obviously. Hundred divided by 10 years. So this will be the excess. Okay, well, let's see how this thing works out. Okay, so this would be our income, and you notice these two should be exactly the same. You know, these two should be the same, and they are. Coming down here, you can go through jump through the hoops, but actually it's just gonna be everything that's over here on the side. I'm gonna do it a little bit differently, and then I'm gonna show it like you normally see it. The income would be added and um, the dividends are subtracted. So these will be the same as these. Okay. Coming down here. Copy, okay. Add in the dividends. We're kind of unmixing the cake. We subtracted dividends before from the investment. Now we're going to add them. Should come out to be 0, and it does. And then this is okay. All right, coming down here. We're going to add the two liabilities together. We still owe the liabilities, but the equity section does not exist anymore for the subsidiary. So these other three are just going to be from the parent company. Let's hope they match. Hey, they do. How about that? Okay, so that finishes up the handout. Any question on that thing? I know I kind of zipped through it. If I ever start going too fast or something, if you look at me, it doesn't happen too often. But if I go too fast, let me know.
Yeah, Professor, I have a question.
Yeah, yeah,
Um, so it's about the current assets and then the fixed assets. Because I realized when you look at a minute, when you look at Bill's financial statement,
yeah,
um, the one at the top, you see the cash and receivables having like 600 and 450 US dollars. But when you scroll down into the other statement, you realize that the cash is now 780 and then the receivables is 750.
yep.
But we don't make adjustments for that. We only make adjustments for the fixed assets. May I ask why?
Actually, as the year goes on, these will change. It's usual to have those change, and actually, the fixed assets could also change. These could also change up here. I kept them the same just to kind of show it, but yeah, these will definitely all change. And it goes by initially when you bought it. So this is only for when you bought it. Now they say land and buildings. It looks like we haven't got any more land and buildings, is why those are the same. But they could definitely have changed.
Okay.
Yeah. Did they change? Wait a minute. 1800 and 1350? Was that right? Yeah, yeah. Those two. Yeah, you're right. Those two haven't changed. So yeah, there would be the extra 300 to get that, and the extra 600 to get to the 90. Yeah. So these two haven't changed, but they could have. These, as you sell stuff, cash comes in. As you pay for stuff, cash goes out. These will all be different during the year than what they were at the beginning. It'd be kind of a weird coincidence. The long-term stuff sometimes does stay the same.
Okay.
You don't if you don't buy another building or whatever. So, but the short-term stuff will definitely change. The cash receivables and all that. These will definitely change.
Okay.
It's an excellent question though. Because you remember this is at the end of the year,
Right.
and this was at the beginning. Yeah.
Okay.
I'll tell you what, it's hard to make these because it's like mixing a cake. You gotta actually do each one separately and say, okay, what if the sales were this? What would they change?
Yeah.
The only one that's similar to this difficult to lay out is excuse me, a statement of cash flows.
Right.
You gotta do everything. You gotta basically like do a statement of cash flows in reverse to get all the accounts right. But
Okay.
yeah,
Thank you.
yeah, no problem. Yeah, so this is what we would do. And again, when you would see this, the consolidate, first of all, Amy would have her own financial statements and so would Bill. They'd be separate. they have their own, they're operating as separate companies, they'll have their lenders and all that kind of stuff. But when it comes to consolidated, uh, it would look like that. That's all you would see. Just the totals. If you look at some company that has, like a large company, almost any large company will have that. If you look at like Ford or something like that, they'll have the Ford financial statements, and then they'll have the consolidated, and those will be just everything. And there are rules on how big the company has to be to consolidate it. I'm not gonna go into it, but usually the 10% rule is almost always, if you're in doubt, the 10% rule, which is if your revenues are 10%, if the income's 10%, or if the assets are 10%, you break those out separately. But if they're less than that, you can just consolidate them. You don't need to break them out separately. Okay. All right. So the next thing we're going to do, and this is the only thing we're going to do tonight, are the uh, uh, lost it. The textbook problems. And textbook problems are, let's see which one. Okay, yeah, there's some quirky ones to this. So one of the things about doing these problems is just kind of getting a feel for what's going on with them. So uh, here's again, they bought 100% of the company. That's good. The cash price paid was 550,000, and the carrying amount for O'Brien's assets were 350. So that was this is the book value. This is not the fair value. So this is book value. Say not. Okay, so these are book value, not fair value for these. Okay, so they said that they had some differences here. Trademarks. Infinite life. Book values are 60,000 and 160,000 was the fair value. So I'm going to put asset change in here instead of excess, or because there is something weird that happens on this one. I mean, what do you call? What's the opposite of excess? Shortage. So let's go. So the normal ones are going to be this trademark, and usually assets, if they are on the books, if they're they're usually they'll be either at the value of the book values, or else they'll be higher. Because generally speaking, if the value is lower, you write them down. Okay, so the excess is trademark fair value is that. And the excess would be 100,000. All right, so excess of that, and I'm not sure if they say how long that's going to last for, but anyway, we'll worry about that later. Customer relationships. This is one of those things that people don't often think about, but this is actually, for some companies, this is actually very big. Customer relationships, their customer list, they don't carry it on the books as anything, but someone buying the business would have it on what the value of it actually is, 75,000. If you buy out a CPA firm, this is what you're going to be buying. or a law firm or whatever, you bring out their customer list. They'll have like, they'll have a computer and all that kind of stuff, but usually that's, a few $100 or something. But the real value of like a CPA firm is the customer list, and trying to keep that customer list intact, and that's what you're really buying when you buy out someone's business, like a tax business or a accounting business or consulting business, any of those kind of things. The customer list is what you're really looking for, or like landscaping or something like that. Yeah, you have a few mowers, but the real value is in the customer list. Okay. Now, here's the wacky thing. They have their equipment on the books at 342,000. We say it's only worth 312,000. So this really isn't an excess. This will be I don't know what you want to call it. Oh, I wonder what word says what's the opposite of excess?
Surplus.
Huh?
Surplus.
Yeah, well, it's supposed to be more. This is less. Shortage, maybe? I don't know. Anyway, it's negative.
Yeah, shortage. Shortage.
Okay, yeah, yeah. I'll put that in. So it's gonna be a little bit wanky. So let's see, the trademarks have an infinite life, so that's not gonna, we're not worried with that. The customer relationships are 5 years. Okay, so this is divided by, oops, 15,000 a year. And this is a 10-year life. So this is actually gonna be a negative expense kind of. Oops, no, not 100 years, 10 years. So this would be negative. I'm sure to put that in. We're gonna reduce the expenses by 300. So that one's gonna be kind of a wacky one. We'll probably do that. We'll do those separately because they're gonna be different. All right, anything else here we need to do? Oh, goodwill. Let's see here. Um, hmm, how are we gonna figure out goodwill? Well, these are the excesses. This is the book value. So this can tell us, I gotta move I'm gonna move the shortage over here. So the net of these is 145. So this is the total excess. Maybe a better word would be net excess assets. I'll leave it total. Okay, so this is our total excess assets we have, the total for all of them together. And this is the carry amount they have on their books. So what would the identifiable assets be? These are all identifiable assets. Should label that. So we're trying to figure out what the goodwill would be. What would be the goodwill? I'm gonna make this right. I'm gonna change this back to regular. Okay, so these are identifiable assets, and the excess of the total excess of, and again, it is a weird term, identifiable assets. But doesn't matter, I guess. So how much goodwill are we gonna have? You want to have a guess? I'll tell you what would be the net assets at fair value? Hey, I don't want those to be yellow. What would be the net asset at fair value? So this is here they are at book value. Here's the excess. Net excess maybe is a better way to put it. Because this is a negative. But what would hey, how come you guys didn't tell me that I put this in here wrong? You guys know I'm a knucklehead. You got to keep track of that kind of stuff. All right, so what would be the total amount, carry amount of the net assets at fair value? Oh, you guys know this. You're toying with me.
So you mentioned that it would be the carrying amount that you would look at and the total excess identifiable assets. So when I minus the 350 is oh well,
You're going to add them in because it's the
Add 'em
carry
in.
amount. Yeah, add them together. So I forgot what color I made that. Oh, that color. Okay, so I'm going to bring this up. So this is what we're going to. So these are the excess over the book values. So this will be the total. Fair value would be those two together. I'm going to put little boxes around these just to make them stand out a little more. So here's the total identifiable assets at fair value. The cash price they paid was this. So the goodwill must have been 550 minus that, was it 55? Yeah, 55,000. So this would be the goodwill. Oh yeah, it's the 550 minus the identifiable. So for whatever reason, they're calling this like the unidentified, I guess. Asset. Okay, well, let's excuse me, let's go ahead and see how this would look. this is one of those things that we're gonna, well, I'll wait until we get to it. So let's go ahead and go through. Let's do the stock first. They don't have any paid in excess. Okay, so some states don't require it. Oops, no, we don't want the retained earnings here. Let's retain earnings at the beginning of the year. So this will be 100. And we need to retain earnings at the beginning of the year. $50. And by the way, that should look very familiar. Total there. The 350 is actually this. Oops, not that. This. If you think about it at book value, what are the assets minus the liability? Well, it's the equity section. So this is the equity section. It's um the net assets at book value is the same thing as the equity section. Okay, assets is going to get a little crazy here. Let's see here. Assets. Well, these are all in wacky order. Okay, let's see. Trademarks. The excess is 100,000. Customer relationships, it was 75,000. I'm gonna peek up here just to make sure I'm not putting stupid stuff up. Yep. Okay, now here's the wacky one. The equipment. We have to take off 30,000. $342. They sold off some of the equipment. Okay, so here you get this wacky thing with the asset. So we have to take those out of. Oops, don't do that. God, is it cold in here? Yeah, I gotta tell maintenance about this place. Okay. Let's see, we'll make those blue. Blue. Now you're gonna subtract out the one for the credit. So this will, actually, it should equal the same as the net assets up top. Yeah, the 145, that's this 145. Okay, dividends declared. Dividends declared, that's gonna be the one that we put back on the books. So we're up to SAD. So Sadie, we have S stock, SS dividends, I is income. So income from O'Brien. So I did something wrong here. What did I do wrong? I'll figure it out later. All right. Expenses. Expenses are going to be kind of wacky. Okay, the 15,000 customer relationship, this will actually be for amortization. Amortization is just like depreciation, but for intangibles. So we're going to expense, the amortization will increase by, I'm going to do these separately. 15,000, and that's kind of the normal one you would think of. All right, so coming down here to, where are we at? Customer relationships. So we're going to take off 15,000 of those. Okay, now for the wacky one, the depreciation expense. We're saying our assets are worth 30,000 less. We're going to depreciate a smaller amount out every year. So that would be, let's see, 10, so this would be a reduction in the depreciation expense. 3,000. And down here, I'm gonna change that because this looks funny. Man, I used all the good colors already. Oh, yellow. Okay, yeah, let's make these yellow. That'll make them jump a little bit. Okay, so our depreciation expense will go down for those. I think we're right. I am gonna run into a problem with this one though, because I know this one can't work out. I'll wait till I get to it. Okay, so let's take a look here. So this would be equal. Well, well, minus. Hopefully this comes out to be. And it does. Same. And by the way, if you're looking at this, you go, okay, O'Brien had income of 222,000 and we only had 210. Difference of 12,000. That's this is the 12,000. 15,000 minus the 3,000 is 12. So we took out 12,000 net out of that to get the 210. That's why these don't match up. Because the expenses. I know what I did wrong. What did I get wrong with the assets? I'll give you a hint. I always get it wrong. The blue one's the assets. There's something I'm missing. What is it?
Goodwill.
Yep. Oopsie daisy. So goodwill is gonna be an asset. The 55,000. Yep. I gotta make that one, is that blue? Color are you? Turquoise, I guess. Doesn't look like turquoise, but anyway. Okay, so I gotta come here. So this is gonna be this plus the goodwill. I think that works out. Okay. All right, well. See, okay, so this would be just whatever the parent has. And this will be negative. Oops. And those two should equal and, well, I just copied them over, so yeah, they do this. So all of this is gone. There are no retained earnings, there's no outstanding stock. The net income is already included in here. This is, doing declared, that actually didn't go anywhere. We own the company 100%. They paid us, it's just moving cash from one to another. All right, let's go down here. So this one will be equal plus any debits and minus any credits. Maybe that one's separately. Okay, so let's see this. Yeah, I think this works out. I think getting this off the books, I think is, I think it works out. Hey. So plus the debits minus the credits. Yay, it's zero. See here, let's go down here, add the liabilities together. And this will just be what the parent company has. There is no outstanding stock. That's not gonna come out right, I don't think. Yes, it is. Why'd you guys say that? Okay, so yeah, so this is, that's it. And again, we had to take this investment off the book. We don't want to count it twice, and so that's why it's going on. And where it's included in these numbers here and up here, but we needed to take it off the book so we don't count it twice. Okay, so let me back this up a little bit. I don't know if you guys want to get screenshots of that or what, but. Back in the day when I was taking the CPA exam, these were always the big ones. So this is the income statement, the statement of retained earnings. You can almost count on one of these being on the test. They always had one of these. They always had a statement of cash flows. Uh, those are just two that you almost. They always had the financial statements too. They had something on the financial statements. What they had that was neat though back then was that they had you could actually pick and choose. Sometimes they'd say, do either 4A or 4B, and they'd have two different, completely different problems. And so, excuse me, you kind of pick which one you wanted to do. Okay, and here's the balance sheet. Let's see something here. So if we add these two up, these should just be off by the equity section, and well, it's not. Why is that? No, it is right. It's 492. So minus, oops, put those two together. That's the equity. That's these two. Okay, there's on that. All right, let's go ahead and take a break. Oh, I'm a little late. Okay. Well, I was goofing around with this stuff earlier. Okay, so let's go. Let's say be back at what time is it? 7:05. Let's say be back at 7:15. Oh, Okay. Okay, let's take a look here. So this is what was paid for it. Fair value consideration paid to Chandler. Okay. The book value was that. Patented, or as the British would say, patented. Was that. Oops. Okay, so I'm gonna move this over here. Oops. All right. So what's going on here? Do we have goodwill? So this undervalued, so this is gonna be the excess asset. So the patents are undervalued by, so you have to add this in. The 204,000 needs to be added into the assets. So what do we have? Do we have goodwill? Oh, come on, it's a yes, no question. Flip a coin. We were only ones.
I say yes.
Actually, it's not. It's gonna be, so this is the total, so the book value plus the fair value for that, I assume. It is kind of a funny way to say it, that, the fair value of those would be underestimated by that. So this would be the total. Um, this is a net. I should say net identifiable assets. At fair value. So, notice the odd thing here. He paid, or they paid, 1,183,000. They got 1,309,000 worth of stuff. We used to call this negative goodwill. Now we're gonna call it a bargain purchase. And maybe that's why they bought it. Hey, that's a good deal, let's buy it. So this will be a bargain purchase. Oops. Of, whatever the difference is between those. Okay. And actually, I guess we didn't need to do that. They already had that for us. I should have read ahead. It's my fault. Okay, well, they already had the bargain purchase in for us, so. Now, again, this is, this goes back to, You know, this is a fairly new rule, and this is one of the weird rule that you actually are gonna recognize a gain on a purchase, which is really strange. You know, usually it's a big no-no, but in this case they do it. And part of the reason why they do it is because if you don't do that, then you have to monkey with the values of the assets. You're purposely misstating assets for years to come, if you don't do this. So I'm assuming, I actually haven't read why they do this, but excuse me, my assumption would be that they say, okay, just take the bargain purchase and then put everything on at the correct value going into the future. Okay, so let's see. I'm gonna do the expenses up here just for kicks. 204,000 divided by 6 equals some number. Oh, I know. I just here. How about this? Since I'm in Excel. There we go. Okay. 34,000. So that's what we're gonna have to expense every year out of it. All right, let's start going through this stuff, see what they have. Oh, this is a nice little short one. Yay. Good one to wrap up on. All right, stock. 100,000. And then we got to go back to the beginning retained earnings. I hope you guys can see those highlighting. If you can't, you know, just yell at me or something. Okay, so we have a stock. And that's that 105,000. Again, at book value, it's going to be exactly the same as the the net assets at book value. Okay, we have to put on the books this patented technology. 204,000. Okay, so that's the only one, I think, right? Yep. And there's no goodwill for me to forget, so that'll be it. Okay, dividends. Dividends are the strange one in that we reduced our investment for the dividends. So now we're gonna add them back in. I don't know why it's got an underline there. Okay, so kind of like we're unmixing the cake here. You know, the difficult part, to find the color. Green. Okay, expenses. Wow, they're being very generous. They have depreciation and amortization together. Don't have to worry about which one it is. Okay, 34,000, so this will be an additional expense. color for it. That color. And oh wait, I missed something. I missed the here's the equity and earnings. That's the same thing as income. Well, let me do the expense just because I'm I stupidly am, like a little kid trying to get out the door. Okay, here we go. So that'll be that one. And now so far we got Sade or Chardonnay, I guess. All right, I we need a color for that. Oh, let's do yellow. Nice and bright. And by the way, you can see here, I think at the 199, the 233 minus the 34 will give you that. Okay. I think we're done with those. Okay. Well, let's start moving them across. Let's see here. Okay, be careful on this one, the bargain purchase, because this is not a negative. This is going to be a positive. That's going to be a positive. That's not a negative. That's money coming in. Hopefully this comes out to 560. Yay, it does. And again, you won't see any of this other stuff on the book. If you're just showing the consolidated financial statements, this is all you can see. Okay, coming down here, these will all end up being just the retained earnings for the parent company. That's all that's left. There are no retained earnings. There's no outstanding shares of stock for. The only dividends that actually reached shareholders were the 100,000. The 40,000 actually did not reach any shareholders. All right. Looks like it's not going to work out. Hey, it does. Okay, coming down here, we're only gonna have this first one. And then we'll have from the parent company, the only stock that's still outstanding. Nobody else owns this stock. It's not outstanding. So let's see. Hopefully this comes out. Hey, it does. Any question on that? Okay, so let me think here. So this would be, so what we're gonna turn in is. I'm gonna check something really quickly. I'll make sure I have these set up in there. Oh, I know what I was gonna do. The ebook came through, of course, after I said, the Laker bundle thing came through. I'll have to set up the ebook again with the Laker bundle one. But the Laker bundle one actually did come through. Yeah, so this is the Laker bundle book. So if you already paid the Laker bundle, it'll be in there. Okay. Okay, get back to me. All right, let me check something though, make sure. Okay, so we can turn in the chapter 3 handout and the chapter 3 textbook problems. So what we'll do next week is I gotta make a decision actually. And here's the decision I gotta make is we do chapter 4. If we do chapter 4, we probably won't be able to do the currency exchange. Um, uh, so here we do next week. I'll give you guys a practice test on the chapter 3. So turn in the 2 handouts. And you do it if you have it, by hand or whatever, that's fine too. Just take pictures of it. So the handouts, and so I turn those in next week. I'll give you guys a practice test for chapter 3. And I'd like to do the foreign currency exchange and maybe even get into the governmental accounting. But we'll worry about that next week. So we'll certainly do the currency exchange. So next week I'll give you the practice exam for chapter 3. And we'll go through that, and then we'll have the exam. Now the exam is going to be for chapter 2 and chapter 3. I'll put them on both on the same one. So we're going to kind of review a little bit of the chapter 2 one, and then we'll go to the chapter 3, which is going to be like this. Any questions? Oh, we're a little early, but that's good because I'm going to freeze to death if I stay here any longer. So I will. I'll talk to you guys next class. So you go ahead and turn in the 2 handouts, and yeah, and I will see you guys next week.
See you, Professor.
Hey, have a good night.
Thank you.
Thank you.
Yeah,
Take care.
I will.